I'm CJ Sturmetz. I'm a certified financial planner and certified equity professional, and this video is meant to be a supplement to go along with the article that you're reading. I thought about doing a little bit more professional of a video, but it's kind of hard to teach stuff, and I'm not very good at generating graphics. So instead, I'm just going to share my screen and walk through and teach you how you can avoid an RSU double tax, which is a big issue, and it's a very common issue that we see with our clients. So if you've ever self-prepared through TurboTax or Free Tax USA or Free Tax USA, not USA, it's an issue that comes up pretty often, and it can cost you thousands to tens of thousands of dollars if you aren't careful. So let's get into it. All right, so the main reason why there is an RSU double tax issue in the first place has to do with how cost basis is tracked. What is cost basis? The easiest definition of cost basis is whatever you paid for something. So cost basis equals whatever you paid for something. Technically, it's a little bit more complicated than that, but for example, if you bought stock for $100, your cost basis would equal $100. It can get a little bit more complicated than that, but at its heart, you can think about cost basis as whatever you paid for something. With RSUs, it gets a little bit weird because, I mean, if you've received RSUs, you know this, you actually don't ever purchase the stock. It vests and then it becomes yours. So let's say RSU vests, you have an RSU vest for $100. Your cost basis on that RSU should also be $100. So as you can see, this is one of the reasons why advisors and people online often say, like, receiving or having RSUs vest is like taking cash or receiving cash and then turning around and purchasing company stock. Because when RSUs vest, you're establishing your cost basis, and it's as though you literally took cash and just turn around and bought stock. So let's look at this. So let's say your cost basis on your RSUs is $100. And then let's say you sold for $120. So you'd have a gain of $20. Very cool. So usually this makes sense. RSUs are both taxed once they vest, and then again at sale, depending on whether or not there's a gain or a loss. So if you sold for $120, you'd have a gain of 20. If you sold your RSU or you sold your stock for $80, you would then have a loss of $20. If you sold for exactly 100, you'd be break even and you'd be able to take the cash and invest elsewhere. Now, the issue is that this cost basis doesn't always track properly and often shows as a big fat zero in tax forms. So in this example, if the cost basis wasn't tracked, showed as zero, and we sold for $100, even though we were supposed to show a gain of zero, we are actually showing a gain of $100, and that $100 will be taxed based on how long we ended up holding the stock. Same thing goes for, with $80, even if it vested at 100, it should have been a loss of $20. But then if our cost basis on the tax forms is showing a zero, it's actually going to show up as a gain. So this is a big issue, and believe it or not, it's something that just happens all the time and happens kind of by default. So I'm going to pause there. We'll get into other topics, but cost basis, this is the explanation of it. All right, so that's enough of cost basis. Let's move over to tax forms, which is probably even less fun than looking at cost basis. So here we go. Here's an example of a 1099-B. Whenever you have stock sales at a brokerage like E-Trade, Charles Schwab, Vanguard, Fidelity, at the end of the year, you'll have a form 1099-B that gets generated, and on it, it will summarize all the transactions that you had at that specific brokerage. So with RSUs, it's the same thing. So if you had RSUs vest during the year at E-Trade or wherever your company holds your company's stock. If you ended up selling RSUs, the information from those transactions will show up here. As you can tell, this form is kind of weird. It's broken up into 2 different sections. One with short-term gains or losses, one with long-term gains or losses. And then within here, there are different boxes saying whether or not the basis of your stock was reported to the IRS. So right here, basis was reported, basis not reported, and those are both short-term. Those both fall under the short-term category, and then down here it's the same thing. So total, there are like 4 very common sections that you can see stock sales. Now, if you look, you can see, maybe I can highlight this in red relatively easily. Yeah. As you can see, this guy appears to be wrong because we had sales, but there's a cost basis of 0. So how does that happen? And then again, you can see it down here with the long-term transactions. We had stock sales of $5,662.68, and then a cost basis of 0. Whenever we see this on a tax form, it's I don't want to say red flag, but it's a big warning sign or flashing lights letting us know that there's probably something going on here. And so this is the form that gets generated. And so if you were to take this and just enter it in whatever TurboTax or Free Tax USA software you use, if you use this just as is, you're going to be paying some amount of extra tax, most likely. So to fix this, a lot of companies will issue a supplemental stock transactions report. I'm going to move this. What that looks like is this. It varies by company, but this is one that a big tech company uses, and your company probably issues something like this, something similar. In fact, I might actually just pull both up on the screen. Yeah, it's going to be hard to see, but I guess like this would work just fine. So companies will generate this stock plan or this stock transactions report because they know that the info over here is incorrect. So let's look at, let's just look at this form on the left for a little bit. So as you can see, let's call our attention to cost basis column and then the adjusted cost basis column. If you look down here at row number 2, the cost basis that was reported, or technically this basis wasn't even reported and was reported, therefore by not being reported, it's reported as 0. But as you can see, this was an RSU that vested on this date. This was the total proceeds that ended up selling, that the stock ended up selling for, and then this is the amount of income that was generated at vest. So the cost basis should be $4,379, but instead it is a 0. And if you look throughout this stock transactions report, you can actually see that this is happening multiple times anytime an RSU is vesting. So here we got a cost basis of 0. Here we have a cost basis of 0, 0, 0, 0, 0, 0. But then even on some of there are some ESPP purchases in here. Even on some of these ESPP purchases, you can see that the cost basis still needed some adjustment because there's a little bit of ordinary income. I don't want to get too into the weeds, but here, even just comparing this, there's some adjustments that need to be made. So the lesson here is that if you have a 1099-B and your company also issues a stock plan or a stock transaction supplement, you should be looking at the supplement to help guide what you are actually entering in your tax prep software. So let's actually look at what a common tax prep software looks like. So this is Free Tax USA. Whenever you go to enter stock plan transactions or stock transactions, this is what it looks like. This is the questionnaire it gives you. So it says, okay, what was the name of the brokerage or bank? Was it a short-term or long-term transaction? What were the sale proceeds? And what was the cost basis? And this is what was the, I believe, reported cost basis. So this is page 1. Then right after that, after you click through and say, yes, looks good, then it will say, tell us more about these stock sales or something to this effect. And it will ask, do you have adjustments to this investment sale? And then it is your responsibility to check yes or no. And if you were to check no and it actually needed an adjustment, you're likely going to end up paying more tax. And it gives a reason if you check yes, and then it pops in here with check all that apply. But yeah, here you go. So this is wrong. And then after this, you can, let's pull up the next spot where it actually asks for the adjustment. So then after going through those 2 screens, then it will pop up with, okay, we show that the reported cost basis was $5,450. Please enter what should be the cost basis, and that's $6,412. So let's I'll show you how we got this. So you'll remember this was the short-term transactions of, actually, I can't even remember what it was. So let's take a look again. Okay, so this was the short-term transactions where basis was reported to the IRS. So if we look at the stock plan transactions, we got this number. So here's capital gain status. So we have short-term on these 4. And then this was a covered one, meaning that the basis was reported. So you can see $5,450 was reported to the IRS. But the actual cost basis, according to the stock transaction supplement, should be this. And then that is what it gets adjusted to. So if no adjustment were made here, there's an extra $1,000 worth of gain that is going reported on your tax return. So depending on your tax bracket and depending on, this was a short-term transaction. So this $1,000 would be taxable at your ordinary income rates. That can be $300. It could be, depending on the state you live in, it could be $500. So it's a very easy mistake and it's super avoidable. All right, so that's basically how you fix it. Now we only looked at one specific type of transaction you can have, and there are 4 total that you can have. So the one we looked at was the short-term gain or loss where the basis was reported, but really you want to look at 4 different transaction types. So looking at this supplemental transaction report, let me make it a little bigger, or a lot bigger rather. Maybe I should have done this at the beginning. You'll want to look at anytime you have RSU sales or ESPP sales, you want to go through and double check to make sure that basis is being tracked properly. So you want to check both long transactions where the basis was reported, long transactions where the basis was not reported. That's what non-covered means. And then same thing on the short-term side. So short-term where the basis was reported, which was what we used for our example, which was technically an ESPP sale, but it's all the same process. And then same thing for the short-term sales where basis was not reported. Now, the tricky thing is depending on the brokerage, you may or may not have a supplemental transactions report. I know that ShareWorks sometimes doesn't generate one, and even big tech companies that you would expect to have a supplemental transaction report generate, they don't generate one. So you may need to use Excel. You may need to use some Google Sheets to go through and double check. But yeah, it's very important you do, because as you saw from our example, it can lead to a lot of extra taxes if you aren't careful. And we definitely don't want you paying extra taxes. So thanks for being patient as we went through this video. It was a little bit rough, but it's fine. That's what happens when you just go through and share your screen. We at EquityFTW are an advice-only firm, which means we're here to give you the advice you need on your equity comp, We're happy to do tax planning. We provide financial advice and do financial planning, all the things that you would expect from an advisor, but we do so for a flat fee, and we don't bill based off of the assets that we manage. And so, it's a relatively unique service offering, and it fits well for a lot of people in tech. If you have any questions about your specific RSUs or how they're being taxed, we're happy to take a look. Feel free to check out our services page, and thank you for being patient. Thank you for watching the video. Have a good day.